Hey guys, Q here from Ianti Trading, and today we're going to talk about how I turned $3,000 into $8,000 in just a few days trading Apple and AMD. So I'm going to talk about why I chose these stocks and in what strategy I traded them. So first, let's talk about why I chose these stocks. So Apple released their earnings report on January 29th of 2018. The earnings report was not very impressive, but it came at a perfect time. Apple hit their targets on spot and they promised a better future for the company, even though they had turned down their revenue estimates earlier in the month. They had said that their iPhone sales were declining, but on their earnings report, their iPhone sales went down by 14% in terms of revenue, but their other products went up by 19%. So investors saw that as a promising key signal for them to keep the stocks in their portfolio. Another perfect opportunity that came from Apple was that the very next day, the Fed was going to announce whether they're going to take it easy on raising interest rates or they're going to raise interest rates. So those two announcements coming back to back, first the earnings report and then the Fed announcement, was very promising as long as that Fed announcement was in a positive way. And so you can see that very next day after Apple releases its earnings, it starts off the day kind of red. However, it consolidates for the first couple hours of the market, not really making a lot of movement. Most of the market did that before the federal announcement, which was completely normal. And many times when it comes close to major announcements like that, investors are shaky. They don't know whether to invest in a bullish manner or a bearish manner. So you see the market consolidate and not do much. And so at this very period, I had not purchased Apple just yet. I was looking for a confirmation time for me to go into Apple safely. And so purchasing any time before this long green candle is very dangerous because this is right before the federal announcement. However, you can see that when the Feds do announce that they're actually keeping interest the same and they're going to be taking it easy, this was very positive news for the market. Therefore, it started to rally. Now, any experienced trader would tell you that anytime such news comes out, especially after a good earnings report, you're going to see the stocks rally. Other stocks rallied as well, but I put my faith in Apple because of their earnings report the previous day. If I zoom out of this stock chart, you can see that Apple had dropped down dramatically ever since they announced that they were not going to be having a good earnings report, that they're not going to be hitting their target expectations. And so when they did announce that earnings report and it was actually decent, this was an opportunity for an investor or a trader to go in and purchase the stock and make profit off its rally. So now let's move on to the AMD stock chart and talk about why I chose this one. I chose AMD for the same exact reason that I chose Apple. Apple and AMD released their earnings the same day. They work side by side, and so a lot of times you're going to see these companies perform the same way in terms of technical analysis. Just like Apple, AMD gapped up the day after earnings because they hit them spot on, beating out Intel's earnings report, which is key competition for AMD. And so they performed on target and they gapped up majorly, and especially when that federal announcement came out. You can see this long green candle indicated that there was a huge buy-in. And so I went into AMD just around this time and made my profits on this run. So let's now talk about some technical analysis that helped me understand if the stock was going to keep going up or it's going to start consolidating and maybe slowing down. AMD's volume indicated that the stock will rally just for a short period of time. You can see that just after the announcement, there was a huge amount of volume, but the stock had already gapped up too much. For such a small cap stock, it was not going to go flying above unbelievable numbers. The stock did go up by about $6, which is very impressive for AMD. Now, AMD had dropped just like Apple in the previous months, but AMD jumping up $6 in one day, that's very impressive for the stock. And so the stock did rally for a short period of time, but I was quick to pull out of AMD because I had known that if I was to hold on to AMD, it's going to start slowing down just as it did before. And you can see that happening multiple times. The stock is actually quite infamous for its sharp highs and sharp lows. Those sharp highs and sharp lows are called volatility. And as an options trader, if you're trading options, volatility is your best friend because every time that a stock moves up and down, you're able to buy call options to make money on the rise and put options to make money on the lows. So why am I bringing up options? The reason why is because that's how I made my money trading these two stocks. So let's go ahead and jump into Robinhood where I actually did this trading. A lot of people do not like Robinhood and I understand why. Robinhood is actually very inaccurate in terms of its charts. They give you 10-minute increments on their candles, which are usually not very accurate. So I'm going to go into the week. And in 1 week, you can see that I made $4,289. So considering I can't show you which options I had bought and purchased because options do have an expiration date, I'm going to take you and show you what numbers I personally look for when I'm buying and selling options. So let's jump into any options. We can go to Trade Kronos Options. Right now, you can see that we're at the top. It says Buy Call. And buying a call, I'm usually an option buyer, not a seller. So I'll explain what buying is. Buying a call and a put option. So what do I look for when I'm looking at call options? Call means that the stock is going to go up, that I'm bullish on the stock. So if we click on any option, you can see that it pulls up this bunch of numbers for you, which really look confusing and difficult to read. But the most important things that I look at would be bid versus ask and the Greeks. So what is bid versus ask? The bid is how much people are willing to pay for a stock versus the ask is how much people are trying to sell the stock for, or the option in this case. And so a tight spread between the bid and the ask is favored. Here you see an 11-cent spread between $1.30 and $1.41. Why do we look for that bid and ask tight spread? The reason why is because the longer the spread is or the wider it is between the two numbers, the less your option will fluctuate in pricing as it moves up and down. So when there's a tight spread, it means that people are close and they are having some kind of common ground when they're asking for the buy and ask. Think of it this way. So if you are in an auction and there's a pair of normal shoes, nothing special about them, and they are asking for a start number of $500 and you know they're only worth about $50, would you be willing to really run up a bid for that number? So the longer the spread is between what you're willing to pay and what the stock option is being sold for, the less likely your numbers are going to fluctuate. Not a lot of people are going to be bidding up. The stock, no matter how much it rises and falls, the spread is just not enough to keep fluctuating between those two numbers because there are so many people asking for such a high amount versus a low amount. So the bid and the ask in this case has a tight spread. This is actually pretty okay. I don't usually recommend doing anything over 50 cents. I would stay under 50 cents and even that's a stretch. So now that we've covered bid and the ask, let's move on to the Greeks. The Greeks may be a little intimidating for you in the beginning, but I'm going to put them in a very simple way for many people to understand. This is not 100% accurate all the time, but it is a very good base to start off on when you're trading options. So I'm going to cover delta first. Delta pretty much means that for every dollar that your stock goes up, you will be making the amount of delta times 100. So if you take 0.49 and you multiply it by 100, you get $49. And so if we write out $49, it means that for every dollar move that Kronos goes up and down, the stock options value will go up by $49 or go down by $49. So again, for every single dollar move that Kronos goes up or down. So if Kronos is trading at $24.50 and it moves up to $25.50, that means your option is now worth $49 more than it was when Kronos was trading at $24.50. What does gamma mean? Gamma is for every second dollar move. So say now Kronos has moved up to $26.50. So now it has 1 plus $1. So $2 move. That means you will gain your $49 times 2 plus gamma, which is 10. So you multiply this by 100 as well. And now you have this entire amount. What is this? 49 times 2. That's $98. That's $108. So now your stock option value has moved up by $108. So you take this 136. So the option price right here is $1.36. You multiply this by 100 and you get $136. So say Kronos has now moved up to 26.50. You add this amount by this amount and your option is now worth more. Then you move on to something called theta. So theta pretty much means time. So options have an expiration date. So at the top, you could see that there is a pull down menu in which you can choose when you want the options you're purchasing to expire. So with this being said, it means that every day that you hold the option's value goes down. So this option is worth $1.36 or 136 because this is multiplied by 100. Every contract holds 100 shares. So you always multiply by 100 to find out the option's cost. So this is $136. And every day that you hold it, you're going to lose $19. And this is the reason why this is $19 is because this is also multiplied by 100. So for every day that you hold this option, the option's value will drop down by $19. These numbers, though, fluctuate all the time. So as you get closer to that date, theta will actually increase. That means that the options value will decrease at a faster pace as you get closer to the February 8th mark. Personally, I don't buy options that expire anytime 2 weeks from the time that I'm buying them. The reason why is because it gives you more time in case things go south. It gives you more time to try to recover before the expiration date happens. Remember, if February 8th comes around and your stock has not hit that strike price that you indicated, the strike price being the price that you're predicting the stock to go to, then the option will completely expire with no value. That means you will lose all your $136. Now, don't get me wrong, you can sell the option anytime before that expiration date. Say things go south and you know that Kronos will not recover and you've lost $36 on this option. You can still sell at any time for that $100. And so now let's cover Vega. Vega is implied volatility. It means how much the stock moves up and down every day. You don't really have to worry about Vega or Rho. Rho is interest rates, but Vega is right over here in implied volatility, which already shows you it's 154%, which is actually insane for a day trader because this is something that you want to look for. You want that implied volatility so you can make your money off those up and down movements. And so now that we've covered what an option call is, back to the Apple and AMD play that I had done earlier in the week for that profit. What I had done was this. I pretty much looked for the right numbers in the Greeks. I looked for a high delta and a high gamma, and I had purchased a reasonable strike price. And so for Apple, I had purchased a reasonable strike price option. So I had predicted that the stock would move up to $168, and you can see it made its way up. I was able to purchase the call options right before that Fed announcement and held through the next day, which was indicated by volume that the stock would keep going up. This is another reason why I bring up volume. Volume is the most critical indicator that you can use as a day trader. You want stocks to have a high volume if you're going to be bullish on them. The buy-in volume has to be very strong for it to keep pushing up into new higher heights. And for options, it's important to know when to get out. Volume can also be an indicator of when the stock is going to go down. So if I'm holding for a few days and I notice that the volume is starting to go into the red and it's starting to move away from the bullish end, that means it's time to get out because options are going to move very quickly up and down. Remember, everything is multiplied by 100. And so if your delta is 0.49 and you multiply that by 100 and it's $49, that means that if the stock moves down that $1, you're going to lose that $49, just like you would gain it as if the stock was to go up. And so anyways, this is how I was able to profit that amount of money. You see, I had 117% return in the past week. I did have the challenge to myself this year. I would start with a small amount of money, and my plan is to turn it into $50,000 by the end of this year. Thank you for watching. Keep up with my videos. If you do like these videos, please subscribe. And if you have any questions or concerns, please leave a comment below. Again, this is Q from Ianti Trading.